Hi, this is Ken, and this is a part of our continuing series on wealth creation in the 21st century. It's your money and your life. Well, today's topic that we're going to talk about is interest, simple interest versus compound interest. Do you have an interest? My little play on words. So many times when I do presentations in live settings, I always start off my presentation with a quote from Albert Einstein that I think is very significant. And that quote is simply this: the significant problems we face today cannot be solved at the same level of thinking at which they were created. And so, in other words, we have to increase our knowledge and increase our thinking in order to solve the problems that we have today. And so, we're going to be talking about simple interest and compound interest and why some people create more and some people wonder why they're not getting as much as they thought they would be getting. So, we will be talking about simple interest versus compound interest. What did Albert Einstein say about compound interest? It is the eighth wonder of the world. But he said something more important than that when he talked about compound interest, and that is simply this: he who understands it earns it. He who doesn't pays it. Now, do you have credit card balances and things of that nature? We'll talk about how interest affects those things. Compound interest can work for you and it can also work against you. So let's go ahead and take a quick, simple illustration of what simple and compound interest looks like. Simple interest is simply this: you have to have a couple of elements. Number one, you have to have principal. We're going to use $1,000 as our principal for our example. And then you have to have a rate of interest. And for our example, we're going to use a rate of interest of 8%. So if you were to look at simple interest and how it's calculated, every year, one, two, three, all the way to year 10, all they do is add 8% to the $1,000. And so at year one, it's 1,080. Year two, you add 80 to that, and it's 1160. Year three, all the way down to year 10, where you now have $800 that you have been put into your account through what's called simple interest, because 80 times 10 is $800. So you had your original amount of principal, which is 1,000, and you add the simple interest over that 10-year period, and you get $1,800. On the other hand, let's take a look at compound interest and how that works. Compound interest is simply this: you take your principal and your interest rate, and each year you would add the what we call winnings or earnings to the next year's interest rate. So in other words, after year one, you had $1,080 like we had in our first example of simple, but instead of only multiplying that 8% times the 1,000 for year two, we're going to add 8% to 1,080, which is $86. And so the next year you would have 1166. And year three, we do the same thing with the 1166 times 8%, and we'd have $172 that we would add, and that would give us $1,339. At year 10, we would have $2,158 of what we call compounded interest on that $1,000. So what does that mean? The difference is simply this: 1,800 versus $2,100. Compound interest is always going to be better for you than simple interest. And so you need to find programs that use compounding instead of simple interest if you're going to create long term wealth. Now, when we talk about finding some of those money products that will allow you to create long term wealth, we have to factor in one more thing. And what I like to call that is a missing link to wealth, because if you don't understand how it works, it can basically erode what you're trying to build financially. In order to win the money game and compound your wealth, you must have your interest earnings beat the silent income reducer. And what is a silent income reducer? The silent income reducer is inflation. So, what is inflation? Well, I like to give the example of taking a basket of groceries. And basic economic theory, they always say take a bag of groceries, and 1 year that bag of groceries costs $5. And let's say the next year that bag of groceries cost $10. Well, we had an increase of the bag of groceries. And what that increase is what we call inflation. And so what happens is inflation will continue to erode simple interest. Now, has anybody ever had that feeling that every year you get a raise, and what do you always say? I'm going to take that money from my raise and I'm going to put it away, and I'm going to, use that money to grow my money. Well, what do you find out? Well, you find out that the amount of electricity you're using may have gone up. You may find out that the amount of the cost of groceries that you pay for every week or every month has gone up. Your insurance that you pay for your car has gone up. All these things go up because of this thing called inflation. And as inflation goes up, if you're not keeping pace with that, then that means you're not winning the money game. So let's take a quick look at how inflation will work for and against you. Let's look at our simple illustration of how inflation works. Let's say we have an interest rate of 3% and an interest rate of 5% that we're getting on our money. If you look at the savings of 3%, 3% of $100 is $3. And let's say we're paying a tax of 25%. So 25% is what we're going to pay on tax on that $3, which would give us a net from $103 down to $102.25. And let's say our inflation rate is 3.5%. Out of 100, that means $3.50. If you take that $3.50 away from that $102.25, you have a net total of 98.75%, which means you actually lost money with a 3% interest rate if the inflation rate is 3.5. Let's take a look at 5%. You have the same $100. At 5%, that means you got $5 on your $100. At 25%, you're paying $1.25 in tax on that $5 for after net of $103.75. Our inflation rate is 3.5, which is $3.50 for our example. You made 25 cents, or you have $100.25. May not sound significant, but you have to understand that inflation actually can take away the buying power and physically erode the money that you have. So think about the money that you may have in a bank right now where you're getting 1% or less interest on that. With inflation, that means every year the buying power of that money is getting smaller and smaller. And this is a clear illustration of how that works. So let's take a look at what this means. What does this mean is simply this. In order to win the money game, which is why we're here, your returns must stay ahead of the current inflation rate. And so you need to find products that will allow you to do that. What products are beating inflation on a regular basis? That is going to be a part of our series where we'll delve into what are the best products that you can put your money into that will give you the best return on your investment, because you have to keep pace or beat inflation in order to win the money game. So remember, simple interest versus compound interest. You always want to look at how can I get my money compounding on a regular basis, because that is how you generate wealth. Wealth is generated through compounding. So let's move on to our next trivia question. The winner of this trivia question will get the book, The Power of Zero. So the first person to respond to me via email will get the book mailed to them, The Power of Zero. So here is our trivia question for this video. What is the minimum level of income for a will to be drafted? How much money do you have to have in order to have a will drafted for you? That is our trivia question. So, as I say, it's time to take action. It's time for you to start your financial foundation now. We can help you put together a roadmap for your financial future. Give us a call, and we can help you protect you and your family and also your assets. You can get your free online quote. And remember, email me the answer. And if you have a question or anything about what we discussed here or on any video that we have in our series, you can always give me a call at that number, 754-800-5549. There is no time like the present to start your roadmap to your financial future. Each day you wait and hold it off is another day that you lose interest. I look forward to talking to you on the next video.